thousands of dollars by just being aware of what I'm going to share with you and getting it right today. So welcome again to our Sunday workshops. If you're new here, my name is Jason J. Hamilton. I'm a certified financial planner and the founder of Keep It Simple Financial Planning. You can find out more about us at keepitsimplefinancial.com. And every Sunday, we're going to bring you a live workshop here. And we're going to help you increase your knowledge and increase your confidence so that as you're on your path to retirement, every single week, you're getting a little bit closer and a little bit more confident, because what we want is for you to feel at peace and in control of your retirement. So that's why we do what we do every single day. So welcome again. And really today, I think this is going to be a very important topic. And it's going to be more important the more money you have, in a sense. I mean, I guess it's pretty important the less money you have as well, because $1,000 a year is a lot of money regardless of who you are and how much money you have. So this workshop is really aimed at all investors. You don't have to have $1 million. You could just have at least something put aside. But if you have $1 million or $2 million and you're not aware of some of these things we're going to talk about today, hey, we could be putting anywhere from $5, $10, $15, or $20,000 in your pocket just by being aware of what we're going to talk about. So I want to welcome everybody. And if you are new here, let us know. Say hello in the chat or something like that. I'd love to say hi back to you, and make sure that you bookmark this page and this site so that you can come back every week and join us. So today we're going to talk a little bit about the mutual fund landscape, okay? So mutual funds are essentially, if you've never heard of them before, if you have a 401k, it's probably what you're keeping your money in, right? You may have heard of things like an S&P 500 fund or a total international fund or things like that. If you have a 401k or an IRA, there's a good chance you have some sort of mutual fund in there. There are a few different types to be aware of. And so, when you're looking at different types, they're pretty similar overall in the way they operate, but there are some slight differences. So if you're to look at like a standard mutual fund or an actively managed mutual fund, those are generally targeted to really outperform a certain benchmark, versus an index fund, which is another type of mutual fund, but an index fund just seeks to track an index, right? So if you have an S&P 500 index fund, that fund is just seeking to track that particular index. And you may have a growth stock mutual fund, and those type of mutual funds generally are trying to outpace an S&P 500 index fund, for example. And then a third type is called an ETF, or an exchange traded fund. And really the big difference between ETF and index fund are the way they trade, right? So a standard mutual fund and an index fund, when you make changes to your account, for example, those will happen at the end of the day. And an ETF trades more like a stock, and those are trading pretty much instantly throughout the day. So I've become a much more big fan of ETFs lately, but there are some great mutual funds and index funds as well out there. But for those of you that have never really thought about this, never really thought about, the all-in cost of what you're paying, I think I'm going to shed some light on something that might be very interesting for you today. So hopefully you saw my note beforehand to bring your statement, because I think this will be a little bit useful for you, so you can compare what we're looking at here. And then also come back to this workshop if you are looking at reallocating your funds, because there might be some good information for you here. So without further ado, let's just jump right into today's discussion, because I have some really good stuff to share with you. So let's see here. Let me pull this up. If you, for any reason, cannot see my screen, please let me know, and I'll be happy to fix it. But it looks like everything's working good on my side. I'm going to get this to play here. All right. Okay, here we go. All right. So what we're going to talk about today is really the study of mutual funds up through the end of 2018, okay? So this information I'm going to share with you today, what it is it's an analysis of returns from a large sample of US-based mutual funds, and the objective is really to assess the performance of active mutual fund managers relative to their benchmarks, okay? So like I said, this study is updated through 2018, and it's going to be pretty clear as I show you that a majority of active fund managers in the sample just failed to deliver, benchmark beating returns after cost. So we believe that the results of this research provide a strong case for relying on market prices when it comes to making investment decisions. Before we jump in, I do have to go over my disclosure here. Nothing I share with you today should be seen as investment advice. It shouldn't be, you should go do this. You should definitely partner with either us or your financial representative so that you do not make a bad decision here, okay? So this should not be seen as tax, legal, investing, or any sort of advice. It's just educational for your purposes, okay? Some things you want to be aware of when you are looking to analyze your investment portfolio. Okay, there are some costs that you can definitely control, and then there's some that are less controllable. But some of the big ones that go into your mutual funds here are things that you may or may not be aware of. So if you look at your mutual fund account and you have things like A shares, okay, A shares generally charge what's called a front load, right? And so you pay money as you put money in. Okay, so some famous radio personalities really like to recommend these because they feel like over time it's a better deal to pay up front versus paying an ongoing fee. But in reality, a lot of these funds really have a large internal expense. And so the internal expense on the fund really doesn't make up for paying that front load. So I would highly advise against paying any front loaded, buying any type of A shares. They're just, paying 5 or 6% off the top. It's just really not a good deal these days. Maybe in the 80s or the 90s, this was the way to invest. But with what we have available now with index funds and ETFs and low-cost mutual funds, it's just really not necessary anymore. And then there's something called B shares. So B shares generally have a back-end load. So if you were to sell within a certain amount of time, you would pay essentially a commission, on the back end of that fund. Sometimes those do go away with long periods of time, but it is something to be aware of. And then there's other funds that have ongoing service fees. So there's something called a 12B1 fee. And if you're working with one of the large companies, I'm not going to mention any names here because I don't want a lawsuit, but if you're working with any of the large broker dealers, you can pretty much guess who I'm talking about. A lot of their funds have 12B1 fees, and there's been tons of lawsuits about this. So I would definitely encourage you just to Google your provider, Google your big broker dealer, Google lawsuits, Google the 12B1 fees, and look into that because this is where there's a lot of hidden fees, okay? 12B1 fees can easily be a 1% fee that you just don't really see. So if your advisor tells you, oh, don't worry, you don't pay me anything, the mutual fund company pays me, generally what's happening is they're hiding that fee in what's called a 12B1 fee, and that's an ongoing fee that is, pretty hard to find sometimes, and sometimes you don't even see it on your statements on a quarterly basis, maybe on an annual basis, but you're gonna have to do some research on that for you to find that. So, and a lot of the times those are what's called C shares. So if you have a C share, that might be something you wanna look at. Number 4 is gonna be expense ratio. So expense ratios are in pretty much every mutual fund, but the amount of the expense ratio varies widely. Okay, and I'm going to show you an example today that might just blow your mind to see how wide these can really vary. And then there's other short-term trading fees sometimes. So if you buy and sell shares too quickly of your mutual funds, and this happens a lot of times inside 401ks within 30 to 90 days, there could be a trading fee. That's not super common, but those do come up, so I wanted to make you aware of those. Okay. So go to our next slide here. Okay, so this slide here is an example of all of the U.S.-based mutual funds at the end of 2018. So there's about 4,576 total. So this is where it gets tricky, right? So if you're trying to design your own portfolio and you are trying to put together a portfolio that's going to, let's say, beat index funds, for example, this is what you got to wade through, right? So there's a lot to really look into here. But, at the end of the day, a lot of these funds are ones you may have heard of. A lot of them you probably never heard of. But there's some really tricky stuff that goes on inside the mutual fund world I'm going to share with you today. But the first thing I want to touch on here is that the global financial markets do process millions of trades worth hundreds of billions of dollars each day. These trades do reflect the viewpoints of buyers and sellers who are investing their capital. So essentially what you're looking at there is, the market's going to kind of determine the price. And generally, when all information that's available is included in the price of the funds or the stocks. And so using these trades as inputs, the market functions as a powerful information processing mechanism. It's really going to bring together lots of information all in together into prices that drive stock prices towards a fair value. So if investors to attempt to outguess prices, you're really putting yourself against the collective wisdom of all market participants. So if you think you're somebody who can outsmart the market, you're really going against all data that is available and every investor that's looking at this data every single day. So the question I have for you is, are you better off as an investor relying on market prices or searching for mispriced securities, right? The mispriced security approach has been the Warren Buffett strategy. Over time, he's done very well at that, but in recent times, he really hasn't done well comparatively to just throwing your money in like an S&P 500 mutual fund. But the mutual fund industry performance offers one test of the market's pricing power, that if markets do not effectively incorporate information into securities prices, then opportunities may arise for professional managers to identify pricing mistakes and convert them into higher returns. So in this scenario, we might expect to see many mutual funds outperforming the benchmarks. So if you're, whoever is managing your portfolio, if if you feel that they can outperform the market, then we might want to see some evidence to that. But what I'm going to share with you here is that evidence actually suggests otherwise. So across thousands of funds, covering a broad range of manager philosophies, objectives, and styles, a high majority actually, of the funds evaluated did not outperform benchmarks after costs. So these findings suggest that investors can rely on market prices. So what that means is, as an investor, it's pretty safe for you to rely on the current market price of the average security. The high majority of security prices are going to be priced fairly, and so you going in and trying to outperform the market on a regular basis is going to be very, very difficult if you're just looking at trying to find mispriced securities. Okay. So here, this graph, it shows the total value of assets under management by category for this sample over the past 20 years through 2018. So collectively, the funds managed over $8 trillion in shareholder wealth. So that's quite a bit of money, okay? Something that you may not realize, is many mutual funds do not survive and outperform, okay? And this is actually one of the biggest reasons behind like the index fund movement, right? So a lot of people looked at this data and said, you know what, forget it. I'm not going to try to outperform anything. I'm just going to throw my money in an index, call it a day. And for a lot of people, it's a good idea. It can make a lot of sense. Not saying it's the ultimate answer, but it can make a lot of sense. But when you look at the amount of mutual funds that actually disappear over time, it's pretty amazing. The size of the mutual fund landscape really can obscure the facts that many funds disappear each year, often due to poor investment performance. So investors may be surprised by how many mutual funds disappear over time. More than half of the equity and fixed income funds were no longer available over 20 years. So if you look down here, over 20 years, if you look at all the mutual funds over 20 years, less than half of them actually survived, okay? So what happens to those funds? A lot of times they get absorbed by other funds that have done well. And so this makes it really tough for you as an investor to really figure out what's going on with your overall portfolio if you're trying to choose funds that are looking to outperform. So really, really tough to do these days. So when you look at if you include these non-surviving funds in the sample, it's really an important part of assessing your mutual fund performance because it offers a more complete view of the fund universe and possible outcomes at the time of fund selection. So the evidence suggests that only a low percentage of funds in the original sample were winners. So the winners are defined as those that both survived and outperformed their benchmarks. So survival rates and outperformance were very low. For the 20-year period here through 2018, only 23% of all funds survived and outperformed their benchmark. So you have a less than 1 in 4 chance to choose these on a consistent basis if you are trying to figure this thing out on your own, okay? So this is for equity funds. So now we're going to talk about fixed income funds. So if you look at fixed income funds, their survival rates were similar to those of equity funds for the same 10, 15, and 20-year periods. But over time, a declining percentage of fixed income funds from the beginning sample survived, and only a fraction of those surviving funds deliver winning performance. So if you look at here over 20 years, only 8% of fixed income funds survived and outperformed their benchmarks. Okay, so if you're looking at your fixed income funds, so that means like basically your bond funds, for example, you got an 8% chance to outperform the general benchmark over a 20-year period. So if you're going into retirement right now, you probably have at least 20 years. So your goal, you should really be looking at what you are doing with your fixed income, especially because ideally fixed income is meant to be like a buffer or a shock absorber, so that if the market does go down, generally fixed income goes up. So it's not where you're trying to get all of your growth from, but over the last 12 months or so, the equity markets haven't done super well. I mean, year to date they're pretty good, but we had our dip in fourth quarter 2018. So some of my high income bond portfolios have done even better than some of the stock portfolios because they didn't face this downside because the shock absorber was there. So looking at your fixed income portion, this is something that can really be important to look at because an 8% chance of winning is pretty small. Okay, so that's something you really want to be considerate of. Okay, so this is where past performance becomes not enough, right? It's not enough to predict future returns. So when you have people that say, look at the track record of a mutual fund and look at the track record, and that's gonna tell you on how you should pick your mutual funds, that's actually horrible advice. It's really, really bad advice. That's not what you should do. I mean, it could be one thing that you look at, but it should not be what you base your performance on. And because in general, a lot of times you're only going to see 5 or 10 years of performance anyways, right? So that doesn't really tell you the whole story. So if you select mutual funds based only on past returns, sometimes good track records do happen by chance, and short-term outperformance fails to repeat. So this exhibit here, this slide here shows that among funds ranked in the top 25% based on their previous 5-year returns, a small minority actually ranked in the top 25% over the following 5-year period. Okay, so when you're looking at, if you're in the newsstand at the grocery store and you're looking at, Fortune magazine or Money magazine, when they have those quote unquote top performing mutual funds over the past 5 years, what this shows you here is that over the following 5 years, only about 1 in 5 of those funds is actually going to be in that top 25% again. So picking your mutual funds, looking at magazines like that, for lack of better terminology, what we call that is like financial pornography, right? It's really not valuable, and it's not a good way to be choosing your mutual funds when you're looking to keep things invested for a long period of time. So this lack of persistence really casts further doubt on the ability of managers to consistently gain an informational advantage on the market. Because what usually happens is these articles come out, and then people get excited. People that are trying to do their own money management, they don't really understand what they're doing sometimes. So they think, oh, wow, well, this sounds good. I'll go into this fund. It's done great over the last 5 years. And then investors will rush to put their money into that fund. And then what happens is, as those funds grow, it becomes really difficult for that manager to continue outperformance over the next 5 years. So as an example here, if you look at equity funds that ranked in the top 25% in the category from 2009 to 2013, only 25% also ranked in the top quartile in the subsequent time from 2014 to 2018. So if you look here from 2009 to 2013, between here and here, right? And then you go down to 2014 to 2018, only 25% of those continue to stay in the top section. So if you're looking at let's say a 5 mutual fund type portfolio, and you pick the top 5 that were in Fortune magazine's recent articles, well then probably 1 in 4 of those actually going to be in that category over the next 5 years. So it's really, really tough to predict this performance based on past results. So, and like I said, some fund managers might be better than others, but track records alone may not provide enough insight to identify management skill. Stock and bond returns in general contain a lot of noise. These days especially, they contain a lot of headlines and tweets and those type of things. So short-term performance, just a lot of noise. But impressive track returns may also result from good luck. Sometimes people just get lucky, and so it's really hard to indicate something that's consistent over time when you're only looking at these short periods. So the assumption that strong past performance will continue often proves faulty, leaving many investors disappointed. So essentially what you're doing is just every few years you're making changes, you're chasing your tail, trying to keep up with whatever that next article is telling you. It's usually not a good way to look at investing, okay? For long term, it's probably going to be very unsuccessful. When we look at fixed income, the past returns of fixed income funds also showed a lack of persistence going forward. Most funds in the top quartile of previous 5-year returns did not repeat their top quartile return for returns in the following 5 years, right? So, for example, among fixed income funds that ranked in the top quartile of performance in their category in the previous period of 2009 to 2013, only 39% also ranked in the top quartile in the subsequent period of 2014 to 18. Over the periods studied, the top quartile persistence of 5-year performance averaged about 28% for fixed income funds. So again, about 1 in 4 or so are going to be in that top category going forward, okay? So here's something that you may not be aware of, okay? That high cost can really reduce performance. And this can have a huge impact on your net returns when you put everything together. It's pretty amazing how big a difference this can make. And I guess a big question is, why do so many funds underperform? And I'm going to tell you straight up, a major factor is costs, which can reduce the investor's net return and increase the hurdle for a fund to outperform. Because if you have an actively managed fund and it's a high cost tier, so if you look at some of these, if some of the costs of your funds, if they're above 1%, and if you're looking over a 20-year period, if it's at like 1.8, you have about 11% chance of outperforming. Even at 0.85 or above, it's about a 37% chance of outperforming. So that's a pretty low success ratio. And it becomes, if you have funds that are disappearing, like talked about in the first slide, then that can make it even more difficult for you to figure out what's really going on. So, if we can consider how one type of explicit cost expense ratios can impact fund performance, when you look at the research, that mutual funds, with the highest expense ratios generally had the lowest rates of outperformance, right? And especially as the longer horizon goes, so as you go on here, from 10, 15 to 20 years, the higher the cost, pretty consistently you can see here that the outperformance gets smaller and smaller and smaller. So really looking at your fees can contribute to underperformance because if you have high fees, it's a pretty good chance you're going to be underperforming because of the high fund cost. So the higher its return the higher the fund's cost, the higher its return must be to outperform its benchmarks. So therefore, investors, you may be able to increase the odds of a successful investment experience by avoiding funds with high expense ratios. So take a look at this, right? Because again, I like to beat up on the big broker dealers because when I look at their portfolios, more than half the time, like 80% of the time, investors have really high cost funds that are sitting here way over 1%. Plus they're paying, sometimes, 1.5% for their investment advice. And then they're not even getting retirement advice. Most of the time they're just getting investment advice. They're not getting tax planning advice. They're not getting Social Security timing advice. They're not getting a comprehensive retirement strategy. They're not getting a retirement income plan. So you're paying all these fees. And then I get people that come to us since we do comprehensive planning that are showing me, hey, I have somebody managing my money, but they won't advise me on retirement. And to me, it just doesn't make any sense, right? It doesn't make any sense when this is what you're doing with your assets. When you look at fixed income, again, it gets almost embarrassingly obvious, right? So having any sort of high expenses on your fixed income portfolio, anything above 0.5%, I mean, it's a almost negative chance, almost zero chance that you're going to outperform over a long period of time. So you really want to look at this. Over a 20-year period through 2018, only 3% of funds that were above 1% for fixed income outpaced their benchmarks, okay? So that's really, really bad. At this point, it's almost criminal for whatever fund family is doing this to continue to charge this fee on fixed income. It makes no sense. So you definitely want to be analyzing your funds to see if you're paying this level of fee, because as you can tell here, it's very, very small chance that you're going to be outperforming and that fee is going to be worth it. I've even seen companies, and these are ones that I know a lot of people like, okay? They have a green logo. Let me put it that way. And I've seen them putting their investors in money market funds that have 0.9%, right? Like this right here. 0.9% fees in a money market. And this is from a big, highly trusted company. I see this all the time, guys. So this is why I wanted to bring this up today for a conversation, because this could be, let's say if you have, $500,000 portfolio, if you're overpaying by 1% in fees, that's $5,000 a year that could be staying in your pocket, okay? The next thing here I want to talk about is trading costs, okay? So turnover. So if you pull up your prospectus, so what a prospectus is every mutual fund will have essentially an information sheet. That's called a prospectus. So you really want to look at the turnover that is going on inside your fund. Pretty obvious here. The higher the turnover, the harder the chance it is going to be to outpace benchmarks. So when you look at other activities that can substantially add to a mutual fund's cost, turnover is going to be a big thing. You know, equity trading, when you look at brokerage fees, bid-ask spreads, and price impact, can be just as large as a fund's expense ratio. So if you have an expense ratio that you're paying, and you're paying these fees on top, you know, it's going to be really, really really hard to achieve that outperformance hurdle and to get over that. When you look at equity funds, portfolio turnover can offer a rough proxy for trading costs. You know, turnover varies dramatically across equity funds, so you can actually look at this on your prospectus. But this can reflect many different management styles. So if you're working with somebody, that this is what if they tell you this, okay? If you hear these type of statements, well, you're going to pay more for our fund, but that's because we're going to be watching it. And when the market goes down, we're not going to go down as much. We might not go up as much over time, but at least you won't go down when the market goes down. That type of thing, you know, when you start hearing that language, and that is true for some active mutual funds, but for the most part, when you look here at how much these funds are trading over time, if you're looking at, you know, 50, 80, or over 100% turnover inside of a mutual fund each year, again, the chances of you keeping up pace or outperforming are going to be very, very low. So you really want to watch this stuff as you are doing this analysis on your retirement portfolio, okay? So just some takeaways here before I show you an example of the mutual fund landscape here. Some of the findings that we went over are outperforming funds were in the minority. Strong track records failed to persist over long periods of time. So track record is not the only thing you're going to be looking at. High cost and excessive turnover may have contributed to underperformance. And so some of the lessons here as well are markets effectively aggregate investor knowledge and expectations into prices that are reliable. So essentially, when you're going to purchase your securities, your mutual funds or whatever you're purchasing, it's pretty, it's very, I would say, reliable that you can rely on the current price being accurate. Doesn't mean the price can't change in the next day, week, or whatever it may be, depending on the next tweet that comes out. But generally, they're pretty accurate. So when you look at managers attempting to outguess market prices, you know, they may incur high costs that raise the barrier to outperforming that particular index. So, you know, if you are going for outperformance, you really want to look at these factors I talked to you about. And then the next lesson is successful fund investing does involve more than just picking a top performing fund from the past. So you really want to consider a fund's market philosophy, robustness and portfolio design, attention to costs, and other factors, okay? So hopefully this was insightful for you. I want to show you an example right now of something else that might blow your mind, okay? Really, really just might blow your mind here. So I'm going to show you an example here. And this is what I want you to do when you have your statement out, okay? So if you have your statement out, you can go to your statement and look for the ticker, okay? The fund ticker is going to look something like just a couple letters, basically, right? So if we look at this one here, we're looking at the Invesco S&P 500 Index Fund Class C, okay? So this is basically, all it is an S&P 500 fund. Nothing very special. The ticker is SPICX, okay? So if you were to search this in Google, this is what will pull up right here, okay? And this is something you can do when you pull out your statement, and you can do this for every fund in your portfolio, and just type it in, and then generally you'll be able to see what the fees are and the returns, okay? So S&P's done very well to this year, so this particular fund has done 19.4%. What you may be surprised at is when you look at the expense ratio of this fund, it's 1.29, okay? So that's really, really high for just a plain vanilla S&P 500 index fund. But as you notice here, this says Class C, right? So if we were to drill down into the cost here, there's probably some 12B1 fees or something going on inside of this fund. I haven't actually looked at that, so don't quote me on that. But either way, the expense ratio here is 1.29%. So that 1.29% just for the fund, let alone if you're paying a manager to help you manage your portfolio, can really hurt your performance. So if we compare this to just like a standard like Vanguard index fund, for example, if you look at year-to-date return, it's 20.44%, right? So 20.44 to 19.4, okay? So it's about a 1% difference, right? So that's a big chunk of money. So let's say you have a, $500,000 in an S&P, for example. Well, that's $5,000 that you would have extra in your account right now if you had this Vanguard one. And the big difference here is look at this expense ratio, okay? It's 0.14%. So 0.14 versus 1.29. So if we take 1.29 and divide it by 0.14, this fund is 9.21 times more expensive than just having a plain vanilla Vanguard index fund, okay? So this is something that most people I talk to, honestly, especially ones that are having their money managed somewhere else, they're not doing it themselves, they've really never taken the time to analyze and to look into. So, I really hope you found this helpful. I really hope you found this helpful today and maybe enlightening, right? And if this is something you've never done, you deserve to do this for yourself, okay? Take some time, sit down, Google the funds, pull up your most recent statement and do this. If you're somebody who is maybe working with a company that puts you in like 20 or 30 funds, that's already a problem, number one. Okay, there's no need for 20 or 30 funds anymore these days. You're just gonna have overlap. It's gonna be a big mess. And the reason they're really doing that probably is to make you not want to deal with it, to be honest with you. Anytime you're getting past 5, 6, 7, or even 10 funds, that's kind of the most you really need to have. You're probably getting to a category where it's just overlap and really hiding things that you may not be able to discover on your own. So my goal for you this week is to have you pull out your statement. You should have gotten a statement at the end of this month, right? Because for third quarter just ended at the end of September, which is why I'm doing this workshop for you today. And start Googling your funds and look at what your fund costs are. And if you're all in, over, 0.5 to 0.8%, that's sort of reasonable. If you're over that, then you may really want to think about your investment strategy and be considering doing some things differently, okay? Because they're going to have some cost. There's always going to be some cost. These, no fee funds, to be honest with you, a lot of times what they do is they make their money somewhere else. They'll keep more money than they should in cash, so then they'll make their money on cash. They trade the fund in a way to where they can have an advantage to their trading to get trades at a lower cost, so then they keep more of the money there. So, those no fee funds, I'm not a big fan of them. I think there's always hidden costs somewhere. And anytime you get something for free, it means you're usually the product, right? So I'd be really careful with those. But if you're in somewhere, like let's say, Vanguard, Charles Schwab, whatever it may be, type of funds, and you have low expense levels, you're probably looking pretty good. But if you're in some of these other funds and you're in a basic vanilla, S&P 500, and you're paying over 1%, you can definitely do better. Okay, you can definitely do better, and I would recommend you consider doing some research on your own to figure out who can help you with that. As always, guys, I want to let you know that we're here to help you if you have any questions, okay? So if you want to schedule an appointment with me personally to discuss your investment portfolio, really anything about retirement, I offer a complimentary 45-minute consultation, generally go an hour or so, but on our call, we're going to look at the most important things that you need to be addressing so that you're on track towards retirement. If you're looking at your investments here and you're like, hey, something looks a little bit fishy, I would like a second set of eyes on what I'm doing here, I'd be happy to help you out. You can go to keepitsimplefinancial.com/talk. Once again, that's keepitsimplefinancial.com/talk. When you go to that page, you will see my calendar there, and you can just choose a time that works for you. And if there's something that's not available, because honestly right now there's limited spots available, but if there's not time that works for you, just keep a lookout and there'll be more times to open up over time. So I hope this was helpful for you today, and I hope it opened your eyes to some things you may not be aware of. And if you have a large portfolio and you're paying over 1% all in on just your investment costs, then maybe I saved you thousands of dollars, and that makes me feel really, really happy. So I appreciate everyone watching today. Have a great afternoon. And if you need anything, I'll just set an appointment with me, and I'll be happy to chat with you guys about whatever is on your mind when it comes to retirement and help you create that step-by-step game plan so that you can retire with confidence. I appreciate you so much. Have a wonderful day, and we'll talk to you next time. All right, bye-bye now.